Greetings from MuniLand. Visiting this week is Philip Fisher, Managing Partner of eBullion Consulting and author of Investing in Municipal Bonds, How to Balance Risk and Reward for Success in Today's Bond Market. Phil, nice to see you. We had two very big stories this week. We had California GO bonds getting upgraded, and we had Illinois, who had to pull a sale and just couldn't get its $500 million GO sale done. What are the lessons learned for retail investors from those two very different stories?
I think in California's case, you learn that the state is constitutionally required to balance its budget, and it does. And it's not a pretty process sometimes, but California is a high beta state, so when the economy improves a little bit, that's enough to do it. And of course, the governor and the state raised taxes quite a bit. With regard to Illinois, the state had a bond deal pulled. It's not the end of the world. There was a rating downgrade and some news, and the state has an obligation to make sure that everybody who's a potential investor knows everything that's relevant about what's going on. So the state probably wasn't going to like the interest rate it was going to get anyway, so they went to their corners, and the state should be expected to talk to the investors and come back at a later date.
Any idea when that might be?
I'm not an insider on this stuff.
What do you see as the biggest issue impacting munis this year?
I think the critical issue is what happens in Washington, and the question is whether or not the Congress would be tempted and, I think, foolish enough to mess around with the tax on muni bonds. I don't think they'll do it. They won't get much for it if they do, and the bondholders are very likely to react badly. I always say that the largest debtor in the world should be nice to the bond investors.
How about issuance? What's your outlook for issuance this year?
Issuance has come out of the blocks very strong, and that's what we expected. We're probably going to see some number like 380 or 400 billion in bond sales. That's being driven to a very large extent by refundings, both what we call current refundings and things we call advance refundings, which create the premium market.
Now, there's been a lot of talk in the press about a possible bond bubble. Is that something you're thinking about? Should muni bond investors be worried about something like that?
Well, interest rates are low, and there's a very good reason for it. The Fed wants interest rates low, and if it could push them lower, it would. The heart of the matter is that while the economy continues to grow at a steady but slow rate, it's not a very powerful economy. We have foot-to-the-floor fiscal policy, foot-to-the-floor policy, and on the monetary side, and all you get is 2% growth and a very high unemployment rate. Rates are low. They could be low for a very long time. People who are concerned about it should make sure they match liabilities and investment maturities, and they should, if they really think they know interest rates are going up, they should just shorten their durations.
So since it's in your title, what is the biggest risk that retail investors have to balance this year?
The retail investors are always in the same basic position. You're not going to trade your way around the muni bond market. What you should do is make sure that you're well diversified. I don't expect any large series of defaults, but you always want to diversify your assets, and you want to make sure that you're comfortable with the maturity and structure of the bonds.
And in terms of reward, also in the title, reward similar this year to last year?
You'll get rewarded, but it's hard to beat the last couple of years.
Philip Fisher, great to see you here. Thanks so much.
Thank you.
Munis, the valuation's not as good as it was in the summer, trading at 90% of Treasury yields for AAA 10-year and AAA 30-year. We were overweight then, but would be careful about adding to overweights because there's still talk of reducing the tax exemption on interest paid, but it's still an area where we think you're pretty safe.
Let's take a look at our deal of the week with Thomson Reuters MMD's Dan Berger. Dan, this is a different kind of deal for you. It's not about yield so much, but you think it's really a market mover potentially.
Yes, it's going to be a bellwether for the muni market because it's a AAA rated credit. It's Prince George's County general obligation bonds, and it's going to be a competitive deal that's going to sell next Tuesday.
So how is it a bellwether?
It's a bellwether because so few muni bonds come to market that are AAA rated. This one's AAA rated by all three rating agencies, and it's pretty substantial. The $324 million is about one of the bigger deals of the week.
What are some of the strengths in this particular offering?
The strengths include the fact that it's located in the D.C. area, so the metrics are very good for the people who live there. It has manageable debt, and it has had stable financial operations.
All right, AAA rated, three agencies. I'm going to ask you anyway, what are the risks?
There are some risks, but they're kind of minimal. One is that it is tied very closely to the federal government. Another risk is that they have a slightly underfunded pension obligation, but they're able to meet their pensions on a current basis.
And how is it structured?
It's going to be structured, most of it, one deal is going to be 15 years, the other deal is going to be 20 years, but most of the bonds are going to be in the 10 to 15 year range.
And does that include a retail offering?
It's not like a negotiated deal where it has a retail offering, but I think retail investors will get preference. It's going to go primarily, I know that your next question is going to go primarily to Maryland state residents, and then bond funds will be interested in this.
All right, Dan, thanks very much. Now, let's look at the week ahead with MMD's Dan Berger. Dan, California's GO bonds upgraded this week. S&P is saying there is some more room potentially for upgrades. What's this going to mean for market activity now in the week ahead?
Well, I'm fairly excited about this. And the reason I'm excited about it is because since the election, the spreads in California GOs, if you look at the 10-year range, have gone from plus 65 basis points, which means that California pays 65 basis points more than the AAA curve for 10-year bonds. It's gone down to 29 basis points. And that's fairly exciting because California has moved from third, only behind Puerto Rico and Illinois, to tied for ninth. And it bodes well for the future for California bonds because we may see some follow-up because the market is going to continue to be very optimistic about those bonds.
What does that mean for issuance in California?
Well, I think they're going to have a large issuance in March, and it's going to be very well received.
How about the calendar for next week, Dan?
The calendar for next week is going to increase slightly, but not much. It was about $4 billion this week, and about next week it's going to be about $4.9 billion.
All right, Dan Berger, thanks so much.
Thank you.
I'm Rhonda Schaffler. This is Reuters.